Every day that God wakes me up, that's a testimony that I will not bend the knee and I will not surrender. If you want to prevent the next 2008, it starts by holding the powerful accountable. Qualitative listening with Kimil Chandler. Hello, America. I'm Kimil Chandler, and this is Qualitative Listening. Tomorrow, the CPI report is going to be releasing, and Donald Trump is definitely going to have a reaction. So I'm going to help you prepare yourself for the CPI report. Well, here's what to expect. The CPI report measures inflation by tracking changes in the prices of a basket of goods and services. For August 12, 2025, forecasts suggest a year-on-year core CPI of 3%, up from 2.9%, and a month-on-month increase of 0.2%. Headline CPI is projected at 2.7% annually. These numbers will shape expectations for the Fed's September rate decision, which markets have at an 88.9% probability of a 25 basis point cut. Here's some key components. Focus on core CPI, excludes volatile food and energy prices, shelter cost, a major driver, and energy prices, as these can sway market reactions. Market sensitivity, higher than expected inflation could reduce rate cut odds, boosting bond yields in the USD while pressuring equities. Lower than expected inflation could fuel a rally in stocks and bonds. Review historical and current market trends. Check recent data. Look at prior CPI reports. For example, July's 2.9% year-on-year, and related indicators like the Producer Price Index, which is due on August 14th, expected at 0.1% month-on-month core. Compare forecasts to actual outcomes to gauge market reactions. Here's some market positioning. As of August 8th, the S&P 500 rose 0.7% to 6,389.45, and the VIX dropped to 15.15, signaling optimism but also potential complacency. High valuations like the S&P 500 and tariff concerns make markets sensitive to surprises. Also, watch bond yields and currencies. Monitor 10-year Treasury yields and the USD index, as they often spike on hot CPI data. Assess your portfolio and strategy. Risk tolerance can be crucial. Evaluate your exposure to CPI-driven volatility equities, especially tech, which may dip if inflation exceeds expectations, while bonds could face pressure if yields rise. Here's some hedging strategies. Options: consider protective puts on equity positions or calls on volatility EFTs to hedge against market drop. Now, for fixed income, short duration bonds or TIPS, which are Treasury inflation protected securities, can mitigate inflation risk. If you're looking at commodities, gold or energy ETFs may benefit from inflationary pressures or tariff impacts. Cash allocation: holding some cash provides flexibility to buy dips if markets overreact. So stay informed and monitor real sources. So here's some pre-release prep. Check consensus forecast on platforms like Bloomberg, Reuters, and Trading Economics. Review Fed statements and FOMC minutes for clues on how inflation data might influence policy. Post-release reaction: watch live market reactions on platforms like CNBC, Bloomberg TV, or X for real-time commentary. Key times: 8:30 for the CPI release. Next, plan for scenarios. What happens if there's higher than expected CPI, which is more than 3% core? Impact could be reduced rate cut odds, stronger USD, higher yields, potential equity sell-off. What action to take? Consider trimming tech exposures, favoring defensive sectors. You like utilities and healthcare, or holding USD dominated assets. What happens if there's lower than expected CPI, which is less than 3% in core? The impact: increased rate cut probability, weaker USD, rallying equities and bonds. What action to take? Lean into growth. Stocks like tech, consumer discretionary, or longer duration bonds. Inline CPI, which is at 3% core. This impact can have a muted reaction, with markets focusing on upcoming PPI and retail sales data. What action to take during this scenario? Maintain balanced positions. Monitor Fed commentary for forward guidance. Next, avoid common pitfalls. Overreacting: markets can overreact to initial CPI numbers only to stabilize later. Avoid knee-jerk trades unless you're a short-term trader. Ignoring context: CPI is one piece of the puzzle. Consider tariff impacts. Next, leverage risk. High leverage can amplify losses if the report surprises. Keep positions manageable. Here's some practical steps to take for August 12th. Night before, review your portfolio for inflation-sensitive assets. Set alerts for 8:30. Check X for late-breaking analyst predictions on market sentiment. What to do during the morning of release? Watch the CPI release live via bls.gov or news outlets. Track immediate market moves like the S&P 500 futures, the US dollar, or 10-year Treasury yields. What to do after the release? Read analyst breakdowns. Adjust positions only if aligned with your strategy and risk tolerance. Alright, that's the show, folks. Thanks for listening to Qualitative Listening.